Let me make sure we're live here. Get that link. All right. Looks like we are live. Robert, I just tweeted it as well. I'll drop that link for you. And we'll roll into this one. Guys, welcome back to Wolf. Welcome to another stream. Got me and Robert coming at you live on X. On YouTube, it's great to see all of you. We're going to chat about the markets a little bit, talk a little bit about Bitcoin, where we're seeing the crypto industry, where we're seeing the broader industry overall. We'll talk about AI a little bit. These are a ton of fun. Hopefully you guys can get some value out of these and you learn something. If you do, definitely be sure to follow Robert. He's got a bunch of great stuff, great content. And yeah, man, if you're excited to get into the stream, please do repost the stream. And we're going to dive right in. A bunch of things to look at. By the way, I'll pull up a chart here, Robert. Yours did drop, but just so you know. And
okay.
No, you're good. You're good. Here we go. So this is across the board, like the commodities here we're sitting at. This is on Ostium here. The gold at just above $5,000 recovered that. There was a bit of period where it was down below 5,000. People were getting a little bit wary. Silver just below $80. Copper $5.78. Across the crypto markets, everything's kind of down, flat / just range bound, has been for a long time. Bitcoin $66,000. Ethereum just below $2,000, just perpetually. I thought I was sharing my screen the entire time, and I was not. There we go. That's the crypto side of things. Here's some of the commodities. If you guys are trying to check those out as well. And so, and then the stocks, I think I have this pulled up. S&P down 0.26%, NASDAQ 0.29% down, VIX is up 3.5% or a bit over 3%. And yeah, just a sad Bitcoin, doing a sad 3% down on Bitcoin there. But anyways, man, we're going to dive into these charts and see what people are thinking. So if you guys are trading anything, if you guys have any insights in these markets, definitely let us know in the chat. Otherwise, Robert, I'd love to get some of your thoughts on current state of the global macro economy. If there's any sectors you think are worth paying more attention to. I know a lot of people have left the crypto industry. We've got like the people who are left are probably the people who are left kind of thing. And so it's been interesting watching it. I feel like it's been like a slow bleed for a lot of people. I know there's a big event in October that probably wiped out a good amount of people. But it seems like a lot of people I know and speak to stuck around. And so we'll see what happens. We still got, for the 4-year cycle people, they've still got 8-9 months before until they're happy again kind of thing. But luckily, the conversation's expanded and everyone's kind of paying attention to all markets now. So I have your charts pulled up here. Would love to get some of your thoughts on things you have some interest in.
Yeah, so the S&P 500, in my opinion, looks pretty weak. We've basically gone nowhere since, October 24th? And that is kind of across the board with Qs, with MAG, MAG 7. It feels like coiled spring, like something is building and we're just not sure what that's going to be. You mentioned VIX being above 20, kind of, for the past week and a half, hasn't really abated. Normally you get VIX up and vol sellers come in and they, smash it down, but we're not seeing that. We're also seeing credit spreads start to widen just a little bit, and dispersion really, really picking up. So dispersion measures the amount of variation within, the basically, how much variation in terms of return are you going to see across, individual names. So, when you have everything kind of moving in tandem, everything down 1% or up 1%, that would be very low dispersion. But when you have, one name here going down 35%, one name here, up by 50%, that sort of thing, that is dispersion. And that's what the blue line is showing. So dispersion up, volatility up, credit spread starting to widen a little bit. We also have liquidity issues again. So let me pull that up. Here is the standing repo facility, and we saw a huge tap yesterday, or excuse me, 17th, so 2 days ago. About $30 billion tapped. Now, this is quite large in kind of the overall scheme of things. We can see that bar here. That's 30 billion. It is the third highest reading going all the way back to the summer of 2020. which obviously kind of a lot going on back then. That was, as liquidity was rising, it was not quite peak liquidity yet. But yeah, standing repo up. And it's not quarter end, it's not year end, it's not month end. This is due in part to the Fed's quantitative tightening, the reverse repo, obviously, which you can kind of think of as a storage tank for kind of excess liquidity that was printed above and beyond what we needed. And at the peak, by the way, the reverse repo was $2.5 trillion. So we printed really a lot of money, to the point that there was so much money that the banks were, what the reverse repo is, this is where the banks have so much cash. There's so much liquidity in the plumbing of the financial system that the banks and the primary dealers have to go to the Fed to give them the cash. And so that's the reverse repo. The standing repo is what we were looking at earlier. That's the exact opposite. That is where the banks are so the liquidity is so short that they have to go to the Fed, pledge collateral in the form of U.S. Treasuries, mortgage backs, in order to get dollars from the Fed. So they're kind of just, the same concept, but just for two different regimes. So you would expect during a scarce liquidity environment, you would expect SRF, the standing repo, to be larger. And when there's abundant liquidity, you would expect the reverse repo to have a larger balance. And sure enough, you can kind of take a spread between the two, right? Take the reverse repo balance and subtract out the standing repo. When that number is positive, you're going to have ample liquidity. When that number is negative, you're going to have scarce liquidity. So we saw a transition away from ample liquidity here back during like Q2, Q3. It was really Q3 of last year. And that is why, obviously, we started to get bank reserves were starting to fall. That was due in part due to the TGA rebuild, where the government's checking account had to be rebuilt from a balance of about 300 billion to about 1 trillion. And what that did was remove that amount of liquidity from the plumbing, from the financial system. So we remove liquidity there, because remember, with the TGA, it's just sitting there. It's just a checking account. It's not doing anything, right? It's just in an account, not really doing anything. So when the TGA gets rebuilt, that's why it matters, is because the liquidity has basically been removed and it's just sitting in an account. It's not doing anything. So TGA rebuild, reverse repo was was dwindling down. The Fed was engaged in quantitative tightening, and all of these were liquidity negative. And that is why we started to get SOFR spreads start to widen. We can look at that here. So here we can see the difference between SOFR, or the secured overnight financing rate, and the reverse repo award rate. So going back to that prior chart here, there is an interest rate that the banks have too much cash during that, when reverse repo was in high use. The banks had way too much cash. They would go to the Fed and loan it to the Fed overnight for an interest rate. Well, that interest rate is actually the Fed's way of trying to control SOFR, control the overnight cost of $1. The price of $1 is the interest rate to borrow $1 overnight, the shortest term loan, which is overnight. And that is what SOFR is. So what the Fed does is they try to control SOFR by setting an upper bound and a lower bound. The lower bound is whatever interest rate is given on the reverse repo. The upper bound is whatever interest rate, whatever money it costs to borrow money from the Fed, right? So what the Fed is doing here is, with the upper line, they're saying discount window and standing repo. What they're saying is, no matter how scarce dollars get, we will always sell them to you at 3.75. So they're kind of a guaranteed seller.
Like insurance
at 3.75. Think about Bitcoin, right? If the Fed stepped in and they said, we will print as much money as required to sell Bitcoin at 90,000. Then imagine that the Fed on the lower side, goes, we will print as much money as required to buy Bitcoin at 70.
Right.
That's what the Fed is doing. I mean, they're not printing money to do this, but that is the kind of concept here. And so, so what we've seen is SOFR spreads, the difference between the actual cost of capital overnight, which is SOFR, $3.5 trillion gets loaned in SOFR every day in the repo market. Every day, three to 3.5 trillion gets loaned in this overnight repo market. So huge amount of money. It's really, really important, what's going on in the plumbing here. And what started to happen was due to the fact that, like we mentioned, quantitative tightening, which just as QE is money printing, quantitative tightening is money destruction, right? So quantitative tightening, very negative for liquidity. Reverse repo, that kind of excess storage tank of excess dollars dwindling out and getting drained out. And of course, TGA rebuild, which is removing every dollar that the TGA goes up is a dollar that's being removed. So all of those being, liquidity negative, what we saw, of course, was bank reserves were quite low. So they got to a low of, I think, 2.7 to 2.8 trillion dollars. And we saw a pretty strong negative correlation with SOFR spreads. So as bank reserves, which are half of the monetary base or the M0, as those reserves dwindled, we saw ever rising SOFR spreads, where what SOFR is telling you is the actual kind of like free market, supply and demand of dollars. What is the supply and what is the demand relative to one another? If the demand for these overnight repo, right, the demand for overnight dollar loans, if that demand is higher than the supply, you're going to get SOFR elevated. I mean, imagine you're the only firm on Wall Street. You are the only bank, the only financial firm that has $10 billion to loan out. Now imagine that everyone else needs dollars, right? Because end of quarter or tax deadline or something like that, or just operations. You get to set a very, very high price, right? And that price being the interest rate. You get to charge, because you're the only guy on Wall Street that's got 10 billion. Everyone needs money. You get to determine the price and you get to set that very high. So when SOFR becomes elevated, that's what it's indicating. It's indicating that liquidity is scarce. There's a shortage of liquidity. And therefore, we see the difference between SOFR and the reverse repo start to grow wider. That is what the green line down here is showing, or this one here, the red line. And then, you add into it, you can't take any one of these in isolation. You kind of have to look at it, the whole big picture. And once you do that, you can see not only were SOFR spreads really kind of blowing out here into the end of the year, but you also had that repo being tapped more and more and more. You can see it was basically never tapped, right, during the ample liquidity environment at all. And then all of a sudden, not only does SOFR start to indicate, whoa, there's a bit of a shortage when it comes to liquidity, as we can see that line moving higher dramatically into the end of the year. Not only that, but we saw another indication that liquidity was short because the repo was being tapped more and more frequently. Well, that started to, number one, that caused the Fed a lot of concern. So Lisa Cook, who, a lot of talk about her with Trump and that whole thing. But she's actually the governor responsible for financial risk evaluation within the Fed. She warned of the repo market causing issue for the basis trade. So the basis trade is a highly, highly levered, 100-to-1 levered trade. I mean, just crazy. Like, they call crypto traders, they call the crypto guys, nuts.
The hypocrisy is insane.
Yeah, it's wild.
100-to-1.
Now, theoretically, with the basis trade, it's basically risk free. It doesn't matter if treasuries go up in yield or down in yield, right? Up in price or down in price. Does not matter to the basis trade. If the basis starts to widen, normally the basis kind of gradually contracts and you get to capture that premium, that tiny little spread
Right.
between the future and the actual treasury. You get to capture that as it goes to zero. That's the basis trade. But every now and again, the basis trade goes the wrong direction. Well, that basis trade, number one, is responsible for absorbing half, almost half, of all the new U.S. debt that has been issued, issued by the government over the past 4 years. Almost half of it has been bought by hedge funds that are doing the basis trade, right? So, like, you look at how much debt we're having to issue just to keep the lights on, and keep going. About half of it is being absorbed by 100 to 1 levered hedge funds in a tax haven engaged in the basis trade. So it's critically important that the basis trade does not fail. Number one. Well, where is that basis trade financed? It's financed in the repo market. And so what happens, or what could happen, if SOFR really kind of does a 2019 where it goes I think it was 900 basis points above the Fed funds. I mean, just it blew out. If that kind of thing were to happen again, it probably wouldn't take 900 basis points for this to happen. But say a couple hundred basis points, what you could get is an unwind of the basis trade. Well, what is an unwind of the basis trade? You have to look at what the basis trade is. You're short the futures and you're long the treasury. So unwinding that would be the opposite. You would go long, you would have to buy back the future, and you would have to sell the US Treasury. While selling US bonds, US Treasury bonds, pushes the price down, yield up. And we've seen, unwinds of the basis trade before. 2020, we saw one kind of April, with Liberation Day. That was part of the reason that we saw yields spike. So the basis trade has unwound before. It's a well-known risk. This basis trade, it's been an issue that the Fed has written about. That various Financial Times, Bloomberg, everyone is well aware of this kind of insane 100 to 1 levered basis trade. Everyone is well aware of this issue. So you had top Fed officials kind of sounding the alarm, and it wasn't just Lisa Cook. It was also the current SOMA manager, so the guy that actually manages the balance sheet, Roberto Perli. He warned about the repo market stress and the kind of liquidity shortage. You had the former SOMA manager, so the person that used to manage the balance sheet. You had them warning as well. You had a number of top Fed officials, even Jerome Powell himself, made public comments about the repo market, right? Highly unusual, because this is very kind of wonky, boring, nerdy thing that no one really ever kind of talks about. And so, yeah, there was clearly stress, and that is why they started money printing. So here is that most recent reserve management purchase, which is where the Fed prints bank reserves to buy T-bills. Basically QE, not technically QE because they're not buying duration, but essentially QE. Now, one of the other contributing factors to this liquidity shortage, not only because we're done with QT, reverse repos kind of been empty for a while now, and TGA is not really doing anything recently. There was the shutdown and a little bit of fluctuation, but nothing major. The only thing I can really think of to cause the kind of most recent elevation in SOFR and repo tapping is this. So we are issuing a huge, staggering amount of T-bills. These are short-dated U.S. Treasuries, 1 month, 3 month, 6 month. We are issuing a staggering amount. Like just yesterday, almost $250 billion was issued in T-bills. That's really kind of the only thing that I can come to, that I can think of for why this is going on again. Because, the Fed's printing money. Reverse repo's basically been empty for a while now, so it's not, anything new. TGA not really moving around. All those kind of traditional metrics, there's really nothing going on. So, we see, by the way, that the rate to finance in that repo market, the $3.2 trillion market. That rate is not one rate, right? We were looking at one rate here, the yellow line. That is just the median. That is just the middle, right? There's a distribution of the rate. And here we can see that distribution. So 25% of the 3.2 trillion has been financed above the upper bound, above that upper limit here. Now the median is kind of brushing up against it, kind of like right there. But yeah, 25% of the 3.2 trillion has been financed above the upper bound, indicating again, we have seen the Fed lose control over the overnight cost of a dollar. With arguably the most important price in the world is SOFR, or the overnight price of a dollar loan. We've seen the Fed lose control. Q2, Q3, Q4, they were losing control. And we can see that with SOFR going well above the upper bound many, many times and staying up above the upper bound. We have also seen the Fed lose control to the downside too. So back when they printed so much money that we kind of didn't know what to do with it, SOFR was actually below the floor, right? So this would be equivalent to the Fed saying, we will print as many dollars as required to keep Bitcoin above 70, but then Bitcoin is 60. That's kind of the equivalent here. So we've seen the Fed lose control, before. We printed really a lot of money back here. And so, SOFR was below the lower bound. Well, what we've been seeing now, that is too much liquidity. What we've been seeing now is, the exact opposite, which is there's a shortage of liquidity. So they'll probably have to ramp up the reserve management purchases that, the QE, not QE, they're going to have to probably ramp this up if this continues. So.
My bad. I thought I didn't realize I was muted. So when this happens, like the general consensus amongst macro, or like people who are following macro, people on TV and like the talking heads and stuff, like what are they generally, are they yapping during this time and they're like screaming from the hilltops, like a Peter Schiff screaming about the, buying gold like 24/7? Like, are they like in sounding the alarm mode when this stuff is happening? Like if they're way under.
They don't even track it.
Okay.
Yeah,
I don't really hear too many people talk about this. Like you're like a very, it's like you and like, I don't know, maybe I don't really know anyone else who like goes out of their way to bring it up,
Yeah, it's very wonky, very nerdy, not something you're going to hear about on CNBC.
Interesting. So they just don't talk about it. That's wild stuff.
Like at all. Yeah, like at all.
Wow. Do they think are they following it and just not talking about it, or you think they're just?
I don't know. Probably not until it gets to a 2019 sort of level. You get a blow up, they'll definitely talk about it. But,
right.
In terms of like, I was sounding the alarm about, kind of a liquidity shortage in like August, right, of last year. Going into September, it started to get even worse. October started to get even worse. And you finally started to have kind of, what I saw in my timeline, finally started to kind of see stuff maybe like November, but like people just don't pay attention to it. It's kind of one of those weird, weird, nerdy, wonky things. But it's huge, right? Like what I kept saying in the videos, warning that this was going to get worse, was look, like at the end of the day, what will eventually happen is the Fed will realize, okay, liquidity got too scarce. We're going to have to print money again. And what do you know, at the December meeting, they announced we're going to print money again. And the balance sheet started to go up. And money, the money printing started. So remember that assets equal liabilities, double entry accounting. So when the balance sheet is going up, they don't just acquire these assets for free, right? The T-bills or treasury bonds or mortgage backs, they have to print money, which is a liability for the Fed. And so, yeah, they'll probably have to print even more money. Right now it's about 50 billion a month. Maybe they take it up to 70. They were kind of talking about front loading the reserve management purchases kind of, at the front end, January, February, I think it was. They might have to increase it even more, because what the repo market is saying is liquidity is too scarce. Even still, you have SOFR spreads widening, and in the standing repo tap for, it's one thing when the standing repo is like, 5 billion, 4 billion, something like that. Okay, take note, but it's really not a big deal. When it's tapped for 30 billion, that, that's a more, that kind of got my attention a little bit, especially because it's not quarter end. It's not tax deadline. None of those kind of things that can cause liquidity to become scarce.
So how much does this go into, like, when you're trading and then you're doing, like, if you ever do like big swing trades and stuff, does this kind of information help you in that sense? Or is this more just to get a pulse on like the overall economy?
Not like I don't really trade this like in particular, right? But it goes into my kind of broader framework. And part of the reason I wasn't buying Bitcoin in Q3, Q4 of last year was because of this. I saw the liquidity shortage coming, going back to like July, August, and I was like, okay, probably not the best time to buy a super high, super sensitive, liquidity sensitive asset like Bitcoin. Probably not the best time to be doing that. And sure enough, we saw. I'll try to pull up a chart here. We saw Bitcoin start to sell off, kind of right as bank reserves were starting to decline. So here is bank reserves, and here is Bitcoin. So bank reserves started to really kind of fall off a cliff here in August. And because again, they had to, if you're going to build up the TGA, remove 700 billion, 800 billion from the plumbing, and you can't go to the storage tank with all the extra money, right? Can't go there. You have to go from bank reserves. And that is kind of the fundamental monetary unit for the banking system, for the financial system. Your money, your check, your deposits in a checking account, in a savings account, that's not what we're talking about. That's the broad money. That's that M2 money supply. What we're talking about here is M0. And it doesn't, like, we don't get to use bank reserves, right? This is something that applies only to the financial system, but obviously critically important for kind of the downstream effect that it can have. So when I saw that, it was like, okay, well, if it can't come from the reverse repo, it's got, Fed's engaged in quantitative tightening. You also have a buildup of the TGA. Man, bank reserves are going to probably start to fall. I mean, that was like the entirety of my August video where I warned that this was going to happen. It was just that. I mean, it's not complicated stuff. And yeah, sure enough, bank reserves fell from 3.3 trillion in mid-August to 2.84 in November, December. And if you look at when Bitcoin kind of double topped here, I think it's pretty clear.
Man.
But on the other, one of the other ways to look at it is when reserves start to go up, when the Fed starts to money print, Bitcoin usually does really well. So you can see those kind of periods of time where bank reserves kind of bottom and start to head higher. So here's one. And, Bitcoin moved significantly higher.
What are your thoughts on
do another one here? It was the low. Look.
Wow. Look at, geez, it was literally. What? Interesting.
Yeah, this is the kind of foundational unit for the financial system, bank reserves. It is the monetary base. And when it gets pretty low, you get it. If we agree, I think most people agree that Bitcoin is, very liquidity sensitive. Well, there's a couple ways of kind of trying to use that, right? You could extrapolate out using broad liquidity. That's M2. You could look at it as, liquidity in the narrow sense, in the monetary base. And that's what we're looking at here. A lot of people within the Bitcoin land look at M2. But like no one really looks at M0 because in order to, it gets pretty wonky once you start kind of getting into this plumbing stuff. So, I understand why, but everyone's looking at M2. No one is looking at the monetary base, which is arguably even more important, even though it's a lot lower, right? 2.9 trillion. This is what M2 is. M2 is 22 trillion. Here are bank reserves down here in white, and then here's M2 green. So, the broad money is way more, way larger. That broad money supply is a lot larger, but arguably kind of even more important for the financial system and financial markets, I would argue, is M0, which is bank reserves plus currency.
Yeah, you don't hear much about M0. You basically see from the main Bitcoin influencer accounts just the M2 money supply. I've seen a big lack in that amount of M2 money supply posting here lately.
Yeah.
But there's been a time where it was every single day, or hash rate or something like that was popping up every other day. I don't see much of that when Bitcoin's going the other direction.
Yeah. So currency, physical dollars is half of the M0. The other half is bank reserves. So currency, we can see, is a liability for the Fed. Currency grows pretty stable. There's really kind of no real fluctuation there. Bank reserves are what are volatile, and that we can see, in the prior chart.
Yeah, talk to me about the. I want to move into a little bit of like AI and tech because, we talked about on previous streams and spaces. All the discussions starting to mesh together in my head, but like a general unease you had mentioned just across the board. Especially in the tech sector. I mean, sometimes it seems too good to be true. Sometimes it seems obvious to get in full port. And we've got, I forgot, I think I was talking to Thomas. He was talking about Druckenmiller. He was just like, buy everything, just get into the market, period. Get a very diversified portfolio because I don't know which way this thing's going to go. I'd love to get some of your thoughts on the tech side of things, on AI. I know we're working with Rex Shares for today's show. There's a couple interesting ETFs on that side of things that we can bring into the discussion later on. But what are your general thoughts here?
Yeah, the market is worried about AI. Here, is software, and the market is concerned that AI is going to eat into the revenue. And also the multiples come in quite a bit. But in general, that AI is going to cause issues for the software sector. And I'm not an AI expert, but I would probably agree with that statement. And we're starting to see it kind of trickle through other industries too. So AI concern with wealth management. So let's see if I can pull it up. Here's Schwab. We can see a couple days ago, we saw a pretty steep sell-off in Schwab. Here we'll measure it from the high there to the low, 13%. And we kind of have this, the meme of the Reaper, going down the doors. It's kind of like that, where, first it was software, then it was wealth management, and we're kind of seeing it trickle through, like run through different sectors as the market tries to determine, how much of a deflationary force. Because remember, just broadly speaking, these publicly traded software companies, wealth management, whatever it may be, these stocks that are getting sold due to AI concerns, those stocks are part of the wealth effect. So if the stock market, for wealth management, I'm just kind of using those two for now, but it could be any sector. If the stock market, those stocks start to decline due to AI concerns getting priced in, then the wealth effect kind of goes into reverse. It goes negative, a negative wealth effect. So consumer spending goes down. So, it's a cascading effect, deflationary effect from, reduction in the value of the stock price due to the fact that the market is guessing, forecasting that company's revenue is going to go down, right? So stock goes down, wealth effect starts to slow or go in reverse, and consumer spending falls. Well, consumer spending falls, that's, 2/3 of GDP. So there's kind of a potential here for cascading deflationary shock due to AI.
Are there any you think it makes sense if you're trying to invest to try and pick the right stock, or do you think it makes a lot more sense to just sort of go more broad? Like, do you think one makes more sense than the other? I mean, like at this point, I feel like people are. I guess it depends which sector of the market you're in, what the time frames are. Like we talk about Bitcoin, if you're super long, that's going to entirely change your position on what you're trying to get in, kind of thing. But do you think it makes more sense to try and isolate and figure out which stocks are going to perform? Like I talked about with Thomas yesterday. He was talking about Apple. Tim Cook's not really going to touch AI nearly as much as some of these other tech CEOs. What are your thoughts on that?
Apple, is notably absent from the whole AI capex. Here, we'll look at how that's faring for them. Pull up Apple.
Oh, let me see if I can find this tweet that Thomas. Keep going, but there's a tweet that Thomas had sent me that I want to pull up and get your thoughts on. It's actually wait, no, hold on. It's it's exactly what you just mentioned. Let me pull this up. We can go back to your chart if yours makes more sense. But this is the post that he had sent me. Let me just give me your thoughts on this one.
I can't see it.
Oh shoot! A sec. Can you see my screen?
No. It's just blank for me.
Really? Wait, hold on.
There we go, I think.
Okay, there we go.
Nope, still not.
Really? Wait, look at
I saw the yeah.
Oh, you are? Okay. How about this?
Here.
Let me switch to here. Let me know if you can see, or let me send you the link to it. It's a tweet. Oh, okay. Wrong tweet. Wrong message. I don't even know why I don't even know how that's possible. It's a message I copied like 30 minutes ago. Okay, I just sent it in the private chat, Robert. It's a tweet from Jason in regards to Apple and the CapEx. It's an interesting chart here. I'll pull yours back up.
Yeah, this is the one I saw.
Okay, cool. Yeah, this is the one we brought up yesterday as well.
So I think what the market is indicating right now is, with dispersion headed higher, is that it is ever more important to pick the right stock. That is really what when dispersion is high, it means that stock picking is more important, right? When everything goes up together, no big deal. You just buy an index, or you can buy, individual names, and they'll go up, right? But when dispersion is high, when volatility is high, I mean, VIX being, kind of like stuck up at 20 is pretty wild. Like, there's clearly a concern within the market, and right now it's about AI and also geopolitical. But yeah, no, I think that, individual picking of what individual name you want to be in is going to be ever more important with, AI. I mean, we've seen, so Apple's kind of holding up, but yeah, Amazon is not. I mean, this, looks pretty bad. We'll go to the daily. That's a pretty significant decline there. Google looks okay, I guess. I mean, this was one of the better performing, Mag 7 trade individual names. This was one of the better performing ones, kind of in the late half of 2025, and it's sold off. Go to Meta. Well, look at Johnson & Johnson. So consumer staples, and that's a different story. But yeah, Meta, selling off. Microsoft looks really bad. It's like picture perfect double top here.
Did you see? I saw Tom Lee tweeted out something about Microsoft yesterday. I'm not sure if we
I
So
mean,
how
this
much
looks
that like
really bad, you
it
know?
was it was something on the fundamentals. I don't believe it was technical related. It was here it is. It was Microsoft director John Stanton buys 1.98 million shares, marking the largest insider buy in 11 years. And Microsoft's still down 15% year to date. But that was an interesting tweet that kind of took hold on X at least last night. And Tom Lee commented on there. But after all his theatrics with Ethereum, I'm not exactly sure how much that
Yeah, I
matters
don't.
to me, you know.
Yeah,
But
yeah.
how accurate is he, by the way, on like non-Ethereum related? Maybe we'll give him the benefit of the doubt in case Ethereum swings up and proves us all
Well,
wrong, kind of thing. But how's he been outside of that?
I mean, he's kind of Dan Ives, like
Mm,
perma bull,
yeah,
kind of like, I mean, yeah, I don't want to say what I really think, but
that's fair.
not like I don't really, Dan Ives and Tom Lee, these kind of guys are just like I don't put really any weight in what they say. I much more appreciate, what Druckenmiller thinks.
Mm,
What
right.
Yeah.
And by the way, on the AI side, I do want to say a big shout to Rex Shares again for sponsoring the show. There was a couple of interesting ETFs I want to bring up and get your thoughts on as well. We talked about before.
Yeah,
Um,
AIPI.
yeah, AIPI was an interesting one. I can pull it up, or if you want to pull it up here
I
as
got it.
well.
Yeah.
By the way, before you do, for people who do want to check this out, there's going to be a link below the stream, and if you're on YouTube, it'll be in the description. If you guys want to check this one out and learn more about it, just let me throw this in there before, just because we're talking ETFs a little bit. You got to make sure we stay within the bounds of the law, because I guess that's important. Maybe not in the crypto industry for everybody, but we want to make sure we cross our T's and dot our I's. An investor should carefully consider a fund's investment objective, risks, charges, and expenses before you get into the investing. A fund's prospectus and summary prospectus contains this and other info about Rex shares. And if you want to obtain the summary prospectus, visit their site at rexshares.com. Again, that link is in the tweet below the stream and in the description if you're on YouTube. The fund's prospectus and summary prospectus should definitely be read very carefully before investing. But yeah, big shots, Rex Shares, one of our longest running clients here at Wolf and a sponsor of the show. But yeah, let me pull this one up for, you got it up right now. Perfect.
Yeah. So, one of the ways, if you're bearish, the Mag 7, one of the ways to express that is by selling calls. And I'm pretty sure I didn't read through the technical notes, but I'm pretty sure that's what this particular one is doing, the equity premium. Usually they're selling volatility. And it's important if people are, looking at these sort of ETFs to always adjust for dividends. Down here on TradingView, it's in the lower corner, because if you look at just the overall share price, you're not going to get the adjustment for the fact that you're getting a yield associated with it. So always make sure to adjust the chart there. I've seen people not understand that and kind of, not really get what's going on. So yeah, dividend yield indicated 40%, 40. So yeah, when you're bearish on something, right, and AI has kind of been underperforming, selling upside volatility is one way to kind of negate. Like if you're long the Mag 7 not doing well, the share price of these companies not doing too well, it set a high back here in October, hasn't set a new all-time high since October. So the rotation started months ago. One of the things you could have been doing is selling upside volatility, right? So maybe I'm on the wrong on percent here. Maybe the 68 call, and then you sell that call and you're getting premium. Now you're short that call because you have 100 shares that you're basically guaranteeing whoever buys your call. You're guaranteeing, look, if the share price gets to 68, I will sell. If they exercise, I will sell my shares to you at 68. That's what that call is indicating. But you're bearish. You don't think it's going to get to 68. You think it might go down or it might go sideways. So you're willing to do that because the person buying the contract pays you money. That's the premium. So that's one way to if you're long Mag 7 from 2025 Liberation Day low right here, and you're still bullish, but kind of short, medium term, you might be, concerned with underperformance. You could sell volatility, and that's what the fund is doing. So yeah, you're down here. The share price of your Mag 7 is down, but
Right.
the premium coming in is buffering that.
What I found is like all the top investors hedge in some capacity. Like they don't always have to be hedging a long with just like a corresponding short, but a lot of times they're doing exactly what you're saying. So they're hedging in other ways. Like there's something they say in the trading space is there's a bull market somewhere. You just got to find it. At some place in the market, you can find a way to still play the game. I'm hoping, especially in these markets, that people aren't just like sticking to one strategy, especially if you're just going sideways forever and you're not seeing any gains at all. I'm like, dude, the markets are moving. Like every sector has things going on. Now, you could probably get unhealthy with it and spend too much time on the charts.
Yeah,
but that's kind of what we do. So I guess I can't really tell people not to, since we're literally live all day, every day. And
I would recommend this. Came up with a particular person who I won't name, but when it comes to my long-term investment, my long-term portfolio, I'm not trying to capture every little 3-month rotation. Consumer staples are going to outperform tech, and I'm like constantly moving around. Remember, you're subject to short-term capital gains, which for me in California is like 40% of my income, right? So like, I would just rather not worry about short-term capital gains, 40% tax, and timing every rotation and every top and every bottom, and like that's just too much for me. Like I'll do that in a trading account, right? I can express that with my kind of smaller trading account, but I'm not going to do that for my long-term portfolio. So, generally, and I spend a lot of time in the macro world and markets and in the charts and the data. So, if someone like me is kind of unwilling to do it, maybe just kind of try to hear that, because it's generally when people try to, capture every little rotation, every little outperformance, and they're trying to do too much, generally they don't do very good. So that would, I can't give financial advice, but that's kind of my personal advice to myself, at least.
Definitely. By the way, did you have any thoughts on the MC, or there's an English? There's an FOMC space I saw in Wolf Financial that was going down yesterday, I believe. There's some information that came out. Do you have any thoughts or any reaction to what happened yesterday?
The Fed meeting minutes came out, and kind of hawkish. There were some indications that members saw a need to hike, which would be crazy. I don't think they will, by the way. I think that, because look, we're in fiscal dominance. That term was being talked about quite a bit, a year ago, 9 months ago. And then it just stopped. And it's like, guys, like fiscal dominance did not go away just like overnight. Like it feels like people think it just went away. Like we're back in monetary dominance. It's not how it works. So, mandatory spending right now, if you total up Social Security, Medicare, Medicaid, interest, you're already at 97% of tax revenue.
Wow.
Just those programs. So fiscal dominance did not go away. The interest expense is out of control. So they can't hike rates, because if they hike rates, then that blows out interest. And if you blow out interest, that blows out the deficit.
Right.
What is the deficit? The amount of new bonds that have to be issued each and every year just to keep the lights on for the government. So yeah, they are not going to hike rates. There was talk, and a couple members, I think the terminology, I didn't dive into it super deep. People will analyze, few versus many versus some, and they try to like read into like how many exactly does some mean, and stuff like that. I didn't really, try to do that. But generally I would say, there were some hawkish elements to it. But I would fade that. Like, I don't think that there's any chance that they're going to hike rates when interest expense is growing at like 10-15% year over year, and the overall economy and tax revenue is only growing at 4-5.
Damn. Yeah, I know there
I mean,
was.
look at this. This is wild.
God, yeah, this is honestly insane. There's too many charts that are looking parabolic like this, dude.
Yeah,
Too
and
many
it's
random
bad.
ones.
It's bad when it's your interest.
I know. God.
Now it came down from a peak.
Oh.
If you look at tax revenue as a share of, or excuse me, interest as a share of tax revenue, if you look at that, it has come down from 26% down to 23, but you're still talking about basically a quarter of every single dollar that you pay in tax going to interest. Now, we run a deficit, right? So it's not, we don't fund everything entirely out of tax revenue, but if we did, it would be probably even higher, but yeah, a quarter. Back, I watched you mentioned Peter Schiff, kind of triggered this memory. He did an RT interview, or like a show maybe, with one other person who I don't remember, but the talk was on emerging market debt, sovereigns, and I think Africa was where they were focusing.
Mhm.
And the line that someone can correct this if it's not correct, but generally kind of the line in the sand for when you're starting to get into worrying debt dynamics is when 20% of your tax revenue is going to interest. Well, we're at 23.
Yep.
So
God, dude.
now back here, during the 80s, debt to GDP was way, way, way lower. I'll put that up. So, because I'm sure people were kind of like, well, look at the 80s. Debt to GDP was basically at a historic low. We're talking 35%. So much different story when your debt to GDP is 125, and you have interest, blowing out like this. And so this is why they have to cut rates. They have to cut rates because the Fed funds, because the long end is not cooperating, right? Long end is going to be there, based on growth, nominal growth, and fiscal concern and that kind of thing. That's what the long end is going to move off. And they're doing nothing to really address the deficit, for example. So you're not going to probably get like a huge move lower in the 30 or the 10. So the way for you to artificially get interest down for the government is to cut the federal funds rate. We know that the T-bills, the 3-month or the 6-month or something, those just follow the Fed, right? And the 2-year kind of, but the short end, and that just follows the Fed. So now there's, little variation with, say, the 1-year, pricing in what is expected by the market into the future. But generally, kind of the front end just does whatever the Fed wants. Well, when the average interest rate on your marketable debt is 3.3, until we can get this below that, interest will only go up, right? Because we never pay off our debt, ever. Debt comes due, we don't pay it off. We issue new debt, new bonds, to pay off the old debt. That is the rolling of the debt that people talk about, the refi. Well, what's going on right now is this average interest rate is kind of creeping up. Every couple quarters, this is going to creep up due to the fact that as debt is coming due, we're refining it at a rate higher than the average, right? So until you get rates below that average, you're in general going to have interest go up. And interest goes up, deficit goes up. Deficit goes up, more bonds must be issued. More bonds must be issued. More bond supply into relatively constant demand for bonds, and price of the bond goes down and yield goes up. So that's kind of the feedback loop, or the vicious cycle that can happen. So what they're going to do is they're going to cut the Fed funds, probably down to at least 2.5, if not 2, to 1.5, depending on kind of weakness in the labor market and, you know, other factors. But they're going to cut a lot. I think a lot more than the market is expecting. They have the excuse of productivity growth exploding. They have that excuse, you know, well, we're cutting rates, but productivity is high, so there's not going to be a ton of inflation. They have that cover to do it, and they'll cut the rate, and the T-bills will, you know, the yield on T-bills will follow. They'll issue or refi, right, more of the debt at those lower T-bill yields, and gradually interest will stop going up parabolically, right? The first thing that's going to happen is that'll start to not go up parabolically. Then it'll, you know, hopefully eventually start to actually come down.
Damn, dude. We got some work. This country's got some work.
I mean, 1.2 trillion per year in interest, not paying down the debt or anything like that, just to service the debt.
Yeah.
1.2 trillion. That's about $3.5 billion per day. So I did a video like 9 months ago on the monthly treasury statement, and it was like $3.1 billion per day on interest. And I was looking back at that. Now it's $3.5 billion per day that we are spending just on interest.
I've been in debt in small amounts, obviously way smaller amounts compared to this. And it's not a good feeling when you're that, and when you're so far that the main thing you got to pay off is just the interest. You're not even making a dent into the actual thing that's costing
principal.
Interest.
Yep.
I can see why no one ever addresses it. Like it's like literally impossible. I mean, I don't know what we would. I don't even know what type of reality we'd live in where this ends up being fixed by paying it off. Like I think they've all sort of just thrown in the towel. Like there's going to have to be a different way that we do this. It's not going to be just paying it off, though. I think that's why when Bitcoin was running up so much, and people were like, "Hey, this Bitcoin argument makes sense. Like they're going to have to, you know, switch over to maybe the stable coins and earn money off yield and all these sorts of things." And I was just like, yeah, maybe that is how they're going to do it. And then crypto obviously went the other direction, so now that narrative's out the window. But otherwise, I still don't know how we're going to address this.
They're going to do
what do you
They're
think?
going to do this. So here's.
And by the way, Robert, I know you have to go in a few minutes, just in case you hadn't seen the. I mean, obviously, I'll keep you as long as you want, but just
here, yeah, we'll show. I'll finish up with this. So
okay.
This is what they're going to do. So you know, I talked about cutting the Fed funds, T-bills, issuing your debt or financing your government in the front end of the yield curve. They can do it. But it's going to be pretty negative for the dollar. And it's going to be pretty stimulatory because T-bills are much less volatile than duration. So they're kind of more liquid. They're more like cash. It's more akin to printing cash than issuing your debt, you know, in issuing duration. What they're going to do is run negative real rates. Here we're looking at the 10-year yield minus inflation. And I'm not sure why trading. Oh, it's because my this. Here, let me fix this. I think GDP should do it. You gotta find something that goes way back. DJI. There we go. So what we're looking at is inflation, or the 10-year yield minus inflation. When the blue line is above the red line, above zero, if you buy the 10-year US Treasury, you're making money. You're actually making money above inflation. When the number is below, or when the blue line is, when that real rate is negative, you are losing money to inflation. You buy $100 worth of bonds, you'll get paid back $100. You'll get your interest, but the problem is that interest is not enough to keep up with inflation and what the actual cost of living is doing. So that's called financial oppression. We did it after World War II. At the peak here, the real rate, if you bought a 10-year Treasury in March of 1947, you were losing 17.5% of your purchasing power every single year. Now, it didn't stay there, right? But that's what they're going to do. They're going to force bondholders to take a loss in real purchasing power terms. And instead of it being probably, you know, 10, 20, 30 year, you know, people that hold duration, it'll probably be the T-bills. You know, if you have a 1% Fed funds rate, right? A 1% short rate, and inflation's 3.5. Well, the government's going to make a dent in controlling the debt. So that's what they're going to do. We ran this before. Many countries have, financial repression playbook. It's kind of their only option. You can't raise taxes because then you constrain growth. Well, you constrain growth and you get into a recession, it spirals. So yeah, this is really kind of their only option because they're not cutting spending. They're not cutting Medicare, Medicaid, Social Security, defense. Those are all kind of going up actually. So this is the only thing they can do is financially repress the bondholders.
They're running out of levers. Like at some point, yeah, I think you're right. At some point they have to do that.
They're not going to be responsible. They're not going to be responsible.
We live in a weird world, Robert. Truly, when you pull apart the data like this, like you step out of like speculation land and you look at the numbers, it's like, what in the world? Who is running this ship? Like, who has got this thing under control? It's like, well,
a bunch of boomers.
Yeah, exactly. Like a bunch of old guys who kind of were like, we'll worry about it in 35 years. And
that don't care.
Exactly.
Right. Because they'll be gone. They don't
care.
And
and probably if I was old too, I'd be less interested in fixing it anyway as well. So I understand. It's not a good thing, but it's
as long as my pension fund doesn't get hurt, for the next 10 years.
Exactly.
That's all I care about.
That's brutal. Well, listen, Robert, I learned something new every single time we do these streams. I appreciate you, man. And hopefully for people who were listening to the stream with us, thank you all so much for tuning in. Can't do these shows without you. If you learned something and you enjoyed yourself, definitely be sure to follow Robert on X and YouTube. Subscribe to his YouTube channel. A lot of his stuff goes very in depth into exactly this type of stuff we talked about today. So go right above our faces. We tagged him above. And definitely follow here at Wolf. If you enjoy content like this, we got spaces and streams every single day. We'll be back on in about 45 minutes talking tokenization, real world assets, all the things going on in that world. And then we've got the Trader Talk discussion as well coming up at 2 p.m. Eastern, an hour after that. So we have spaces all the time. And Robert joins us as often as we can get him on the spaces as well. Those are a ton of fun. We get panels together of experts. We talk about these markets. So yeah, man, again, if you want to check out those RexShares ETFs as well, that link is down below this stream, the tweet below the stream. And if you're on YouTube, it's in the description. So if you guys want to check that out, definitely do so. We'll see you guys all in the next one. Have an amazing day.